Imagine a day when the opening bell of the New York Stock Exchange rings not from Wall Street, but from Dallas or Miami. It sounds like fiction, a plot from a financial thriller. Yet, in the world of markets, the unthinkable can become reality with startling speed. This scenario represents what analysts call a black swan event. A surprise occurrence with a massive impact, one we rationalize only after it has happened. The 2008 financial crisis was a black swan. The global COVID-19 pandemic was another. The forced departure of the NYSE from its home of over 2 centuries would be a black swan of historic proportions. It would shake the very foundations of global finance. The New York Stock Exchange is far more than just a building at 11 Wall Street. It is a potent global symbol of American capitalism, recognized in Tokyo, recognized in London. For generations, its iconic facade has represented opportunity. The chaotic energy of its trading floor has represented risk, and the trading floor has embodied the relentless pulse of the global economy. Its location is not incidental. It is the anchor of the world's most important financial district. The question is not just logistical. The core inquiry: could political or economic pressures become so intense they rip this anchor from its moorings? What would happen in the moments that followed? What would happen in the months that followed? The primary catalyst for such a move would almost certainly be policy-driven. Imagine New York City or the state of New York facing fiscal pressures, implements a new financial transaction tax, or a set of regulations perceived as overtly hostile by the financial industry. Such measures could reach a tipping point where the cost and friction of staying outweigh the benefits. The leadership of the exchange, backed by its most powerful member firms, might then decide to relocate to a more business-friendly jurisdiction, perhaps to Texas or to Florida. This would not simply be a corporate relocation. It would be a powerful public declaration. It would signal a breakdown of trust between the financial industry and one of the world's great cities. The departure would be framed as a flight from an untenable business environment, a vote of no confidence echoing far beyond the Hudson River. The shock would not be about moving servers, nor about moving personnel. It would be about the symbolic message. The ecosystem that nurtured American finance has become inhospitable. This is the precipice from which a black swan takes flight, leaving stability and predictability in its wake. The moment the news breaks, the reaction would be instantaneous and severe. Global headlines would flash across screens in every time zone. Headline: NYSE to abandon New York. Before the logistical details could even be processed, a wave of pure, unadulterated fear would wash over the markets. Investors, large institutions. Investors, small individual traders. A simple primal instinct: sell first, ask questions later. Initial carnage concentrated in firms tied to New York's financial ecosystem. Stocks of major banks would plummet. Brokerage houses would collapse. Investment firms would tumble. The shock would ripple into the physical world. New York commercial real estate hit hard. REITs exposed to Manhattan office towers would collapse. REITs exposed to retail spaces would collapse. This sector is already fragile in the post-pandemic era of remote work, high vacancy rates, and declining property values. The exodus of the NYSE and orbiting firms would create a decades-long vacuum of demand. The panic becomes a feedback loop. Falling prices trigger margin calls. Margin calls force more selling and deepen the crisis. Beyond price drops, market mechanics would seize up. A sudden and catastrophic liquidity crisis would unfold. Trading algorithms could malfunction. Firms might switch algorithms off entirely. The bid-ask spread would widen dramatically. Trading becomes far more expensive and difficult. Electronic gridlock amplifies human panic. VIX, the market's fear gauge, would surge. Levels not seen since 2008. Levels not seen since 2020. A VIX above 40 or 50 becomes a real possibility. Price discovery breaks down. No one knows what anything is truly worth. The system becomes the source of risk. Symbolic crisis turns into mechanical failure of the global financial system's central nervous system. In the days and weeks following the initial shock, capital would move in a predictable, fear-driven pattern. The first sector to be hit, financials, would continue to bleed as investors reassess the long-term viability and profitability of firms tied to New York. The second domino to fall would be the broader services and luxury sectors connected to the city's wealth. High-end retail, hospitality, advertising. Any business dependent on Manhattan's wealth and corporate activity would face a grim outlook. The market would follow a clear risk-off trajectory, money fleeing anything seen as discretionary or cyclical. Capital exits, seeking a safe harbor. That triggers a rally in defensive stocks. Companies in sectors like consumer staples, food, beverages, household goods, utilities, healthcare would see significant inflows. Essential goods and services remain needed regardless of economic conditions. Investors also flock to defense stocks, aerospace stocks, often seen as insulated from domestic turmoil. Alongside defensive equities, precious metals would surge. Gold, the ultimate store of value in chaos, would likely spike dramatically as investors and central banks seek a reliable hedge against systemic instability and a potentially weakening US dollar. Some flight capital might also flow into digital assets. Cryptocurrencies like Bitcoin, touted as digital gold, would face their biggest test yet. They could validate their safe haven status or be exposed as risk-on speculative tools. The US dollar would come under immense pressure globally. International investors would question the dollar's reserve status. Capital might flow into the Swiss franc, the Japanese yen, other sovereign bonds. A weaker dollar could stoke domestic inflation while making US exports cheaper abroad. The short-term scramble is not just a stock event, it is a global realignment of capital driven by one emotion: fear. Once the initial market panic subsides, the medium-term economic consequences would begin to set in, creating deep and lasting scars, The most direct impact would be a wave of capital flight, not just from a market sector, but from a geographic location. The NYSE's departure would trigger a strategic reassessment by every financial firm in New York. Executives would be forced to ask, if the exchange can leave, why are we still here? This would lead to a gradual but relentless migration of jobs, intellectual capital, and corporate headquarters to states like Florida, Texas, or North Carolina, lured by the promise of a more favorable tax and regulatory climate. This corporate exodus would decimate New York's tax base. The financial industry is the city's and state's golden goose, contributing billions of dollars annually in income, corporate, and transaction taxes. The loss of this revenue would create a fiscal black hole in government budgets. Municipal and state leaders would face an impossible choice: drastically cut essential public services like transportation, education, and sanitation, or raise taxes on the remaining residents and businesses. Either path risks creating a vicious cycle where declining services and higher taxes prompt even more people and companies to leave, further eroding the tax base. This situation would ignite fierce competition among states in a phenomenon known as regulatory arbitrage. States would actively compete to attract the fleeing financial firms by offering ever lower tax rates and lighter regulatory oversight. While this might seem like a win for the states that succeed in attracting these businesses, it could lead to a race to the bottom on a national level. The patchwork of different rules could weaken overall financial stability, creating loopholes that could be exploited and potentially sowing the seeds of a future crisis. The United States market, once seen as a cohesive whole, would begin to look fractured and inconsistent. Foreign investors would watch this internal U.S. conflict with growing alarm. The perception of the United States as a stable, predictable, and unified market for investment would be shattered. The spectacle of a major financial institution fleeing its home due to political disputes would damage America's brand of capitalism. Global capital is skittish. It values stability above all else. Even if the market's infrastructure ultimately resettles and functions effectively in a new location, the reputational damage would be profound. The world would ask, if the U.S. cannot maintain stability within its own borders, how can it be trusted as the anchor of the global financial system? To understand the potential magnitude of this event, it is useful to compare it to past market shocks, but it is crucial to recognize its unique nature. The dot-com bubble burst of 2000 was primarily a crisis of valuation concentrated in the technology sector. After the froth was blown off, the underlying innovation of the internet continued, reshaping the economy. The 2008 financial crisis was a crisis of credit and leverage, born from complex derivatives and a housing market collapse. It led to a painful recession and fundamental, long-lasting reforms in the banking industry. The COVID-19 shock of 2020 was an external, biological event that forced a sudden stop to the global economy and accelerated trends like remote work. An NYSE departure would be fundamentally different from all of these. It would not be a crisis of valuation. It would not be a crisis of credit. It would not be a crisis of biology. It would be a crisis of confidence. It would be a crisis of political stability. Unlike the dot-com bust, its impact would not be contained to a single sector. Unlike the 2008 meltdown, it would not be caused by complex financial instruments that few understood. And unlike the pandemic, it would not be an external act of nature. This would be a self-inflicted wound, a deliberate choice made by humans in positions of power. The shock would be born not from market mechanics, but from a breakdown in the social and political contract that underpins the market itself. This symbolic nature is what makes the event so powerful and its fallout so unpredictable. Financial markets are not just a collection of numbers and algorithms. They are built on a bedrock of trust, convention, and belief. The belief that New York is the center of the financial world is one of the most powerful conventions we have. Tearing it down would call everything into question. If the NYSE can move, what other pillars of the financial system are less permanent than we thought? This type of existential uncertainty is far harder to model and contain than a drop in housing prices or a failed technology company. The recovery from such a shock would also follow a different path. After 2008, the solution involved massive liquidity injections from the Federal Reserve and new legislation, like Dodd-Frank, to repair the banking system. After COVID, stimulus checks and vaccine development helped restore economic activity. But how do you legislate a solution to a loss of faith? How does a central bank print more trust? The damage would be to the nation's reputation. Rebuilding that confidence would be a generational task, far more complex than refinancing bad debt or developing a new vaccine. The scar left by this crisis would be on the world's perception of America's stability. For the average investor, witnessing such a black swan event would be terrifying. The temptation to panic and sell everything would be immense. However, the wisest course of action is one of preparation and disciplined response, not reflexive fear. The first and most critical step is to understand and acknowledge the risk before it happens. Every investor should have a portion of their portfolio that is resilient to extreme market shocks. This means maintaining a healthy allocation of cash or cash equivalents, such as short-term treasury bills. In a crisis, cash is not just a safety net. It provides the liquidity needed to manage life's expenses and the opportunity to buy assets when they are undervalued. Diversification is the investor's most reliable shield. A well-diversified portfolio should be spread not just across different stocks and bonds, but across different sectors, geographies, and asset classes. An investor holding only financial stocks and New York real estate would be wiped out. One with holdings in international equities, commodities, and defensive U.S. sectors would be far better insulated. Furthermore, considering explicit hedges can be prudent. A small allocation to assets like gold or other precious metals, which tend to perform well when confidence in paper currency and financial systems falters, can act as valuable portfolio insurance. When the crisis hits, the cardinal rule is, do not act on pure emotion. The initial moments will be defined by chaos and misinformation. It is vital to step back, resist the urge to follow the herd, and wait for the dust to settle. The prospect of the NYSE leaving New York is a cautionary tale, a stress test for our institutions. The solution, or rather the prevention, lies in the hands of policymakers, business leaders. Prudence, open dialogue must prevail over political brinkmanship. City leaders, state leaders, must perform a delicate balancing act. They must meet their fiscal obligations without creating a business environment so punitive that it drives away the very industries that generate their revenue. Smart, forward-looking policy involves collaboration with business leaders, not confrontation. Stability is a shared interest. A tax base that has fled generates no revenue at all. For their part, national leaders, federal regulators, have a duty to safeguard the integrity and stability of U.S. market infrastructure. This is a matter of national economic security. They should work to ensure that the regulatory environment is robust and consistent across the country, discouraging a destructive race to the bottom among states. The core systems that facilitate trading, clearing, settlement must be protected from physical threats, political threats. The perception that the U.S. financial market is fair, transparent, stable is one of our country's most valuable strategic assets. In the end, the story of the NYSE is the story of trust. The physical location on Wall Street is less important than the centuries of confidence it has accumulated. If that trust is broken by a politically motivated move, the consequences would be severe and long-lasting. The initial headlines, market panic, would be just the beginning. The deeper damage would be the erosion of confidence in the stability of American institutions, a loss that would ripple through the global economy for years to come. We cannot predict every detail of such a crisis, but we can recognize the immense danger it represents. Investors can prepare their portfolios. Policymakers can choose the path of cooperation. The ultimate lesson is that market stability is a public good, fragile, indispensable. The cost of losing that good would be measured not just in tax dollars, stock market points, but in the erosion of the trust that holds the entire system together. The great financial centers of the world are not built on concrete, steel alone. They are built on the bedrock of predictability, faith. Final thought: markets live on trust. If the NYSE leaves New York, the world will see that trust is broken. The response will shape markets for years.